Good morning, everyone, and welcome to NZ Funds Connects. I'm James Greger, Chief Investment Officer for NZ Funds, and every week we're taking the opportunity to bring you a variety of perspectives on financial markets, financial advice, and developments here at NZ Funds. It is Monday, 13th of December at 9 a.m. As inflation and interest rates increase, bond portfolios have experienced volatility. Mark Brooks takes a step back to discuss why interest rates present a challenging environment for bond portfolios, but also create a significant opportunity. But first, I'm very pleased to welcome to NZ Funds Connects Christina Luang, Principal Economist at the New Zealand Institute of Economic Research, or NZIER. As Principal Economist, Christina looks after economic forecasts and analysis of the Institute's quarterly survey of business opinion. She has over 10 years' experience in the public and private sectors, having worked at the Reserve Bank of New Zealand and ASB Bank. Christina, really appreciate you joining us this morning. And look, there's huge amounts to cover and a broad range of topics. But perhaps before we jump into, the details of your economic views and predictions of the future, which is probably the hardest job known to anybody, perhaps tell us what the NZIR actually is and what your role is, because it is quite different from many other guests we've had on NZ Funds Connect in terms of other economists and bank economists. So why don't you launch into that, and thanks so much. Really looking forward to the chat.
Yeah, thanks for having me on your webinar. So firstly, NZIR, I head up membership services and the Auckland business. So there's three main strands to NZIR. So we're first and foremost, we're a membership-based organisation. So we have over 100 membership organisations which receive our forecasts and have access to a wide range of our information. Also, we each year we produce a program of public good research. So we dedicate a portion of our revenue to this public good research, where we produce research for the wider public on a range of issues that we feel are important in terms of getting that discussion out there, and also that awareness, particularly around, for example, well-being and how that affects New Zealand. And then, of course, there's our external consultancy work, which everyone at NZIR is involved with, and that's where we work with a range of clients looking at a range of different issues. So, for example, for myself, I've looked at a lot of wider economic impact, for example, on congestion on the Auckland economy, and also the wider economic impact of particular investments, for example, major transport investments, and what that means for the economy. So that's a very quick spiel of what we do at NZIR in terms of how it's different from being a bank economist. So I was bank economists once upon a time, and I would say that the main difference is that our client is different in the sense that as a bank economist, your main client is traders and dealers, and so a lot of what you think about the outlook for the New Zealand economy relates back to what it means for interest rates over the coming year, because at the end of the day, you're helping traders particularly to put positions in the money market that will help them make money. So interest rates, the outlook and the implications for interest rates play a large part into that. Here at NZIR, we do look at the economy in great detail, but in terms of the implications, it's more for a policy-making perspective. So whether that is in terms of over the coming year, which particular sectors will do well and not do so well. If it's something that we need will require, for example, government intervention or any other policy interventions that would mitigate some of the risk and also help us to achieve the outcome that we want at the end of it. So a large part of that is how the difference in what I do is the outlook for the economy, but the difference in whether it's how it affects interest rates. As a bank economist, that's a large focus. Whereas here, yes, interest rates does play a part in it, but also what it means for policy making down the track. So I would say that's the short spiel of it in terms of the key things.
Must be pretty refreshing after a time spent at a bank not having to talk about solely interest rates and what people like us think over the next 3 days, rather than actually think a bit more longer term.
Yeah, the fact that you can have sit back and think, okay, so this is what it means for the short term. And we really saw this, for example, with COVID, right? Absolutely, it was right for the government and the Reserve Bank to step in the short term to have policy interventions that kept the economy operating. So things such as the wage subsidy from the government, and then also the liquidity in the money markets from the Reserve Bank. So those are the main things in the short term. But then over the longer term, it's more thinking about the policies that we want to have in place to build a resilient New Zealand economy. So things such as how we are able to allow households and businesses to adapt to changing conditions, given how fast things are changing, particularly with COVID around. Also, we have thought in terms of NZIR, and thought I'd note that we've got two main offices. So in Wellington, which is where we have been operating since the 1960s, and then also more recently in Auckland, so 7 years ago, which is when I joined. So also we have a staff member in the South Island as well, so things that side of things.
So when you think about the sectors that you mentioned, transport in Auckland, and it's probably a big part of all Aucklanders' life as they sit in traffic and think about congestion. But what are the specific sectors of work you've done recently that you think is one interesting, but going to be a massive decision points for governments and policy going forward? Are there certain sectors that you've really focused on that you think changes need to happen for New Zealand to progress?
So at the moment, a lot of my work is around the construction sector, and that is the nature of the clients that I'm working with currently. So in terms of COVID, it's played a large part in the outlook for the construction sector. Even prior to COVID, of course, we've been having that in terms of the housing shortage, what it meant for construction demand, and how we could get that construction ramping up over the coming years, both from a residential construction point of view, but also from infrastructure, so that we can keep up with that demand from the increase in population growth. Now, of course, with the border closures, we currently have border population growth at very low levels, given the lack of net migration. But that said, we still have a lot of catch up to do from the years of strong population growth that we've had. So in thinking about what's happening with the construction sector, we've got a very strong demand, and we can see that come through a lot of the indicators from building consents all the way through to our own NZA quarterly survey of business opinion, which asks architects in terms of what they're seeing in their own office across housing, commercial and government work, and what that means in terms of the pipeline of construction work over the coming years. And what we're seeing is that there remains a strong pipeline of residential and government work, whereas businesses are feeling a bit more cautious when it comes to commercial work. So that from the COVID and particularly with the new variant coming through, makes it a bit more harder for businesses to plan, and so there has been a bit more of that holding off on making large-scale investments. But that said, in terms of what's going on with construction, that's strong demand. And then on top of that, with the supply constraints that are coming through. So what that means for cost escalation, and in turn, the degree to which construction can ramp up over the coming years.
So do you see, and I hate being, typical kind of delving into housing market as soon as you talk to an economist, but when you think about the reasons for big price increases, especially in Auckland, but also housing throughout New Zealand. And when you think about the construction industry and perhaps, in the shorter term, the supply chain constraints. But in the work that you've done over the years and even before COVID, is this a big part of why we've got a housing crisis? There's just been not enough building?
Yeah, so in terms of that plays a part into it. So I always like to say that for any investment, it comes down to the rate of return versus the cost of borrowing. So over this period, we've had interest rate. I'm trying to think when we've had high interest rates, but that we're looking very far back. So we've had this period where interest rates have been extremely low. So in terms of that has meant very low cost of borrowing. And then when there is that continued expectation that the rate of return at the end of it is going to be a lot higher, given that in this equation, you've got the expected rate of return far outweighs this very low cost of borrowing. That's where you've had a lot of people pile into particularly into housing. So how do we change this equation? So we're starting to see interest rates start to pick up. So that will mean that in terms of the cost of borrowing, there will be a lot sharper focus on the rate of return required to make housing an attractive investment. And then when it comes to this expected rate of return, it comes down to whether there is that belief that the strong amount of house building activity that we're going on will help to see house prices, I wouldn't want to say fall, but certainly not rise at the rates that we've been seeing, in which case then this equation no longer makes housing such an attractive investment. So a lot of it comes down to how credible are we able to, in terms of believing that house price is not this gravy, housing market, I should say, is not this gravy train where house prices will just keep rising and rising. in which case then even as interest rates increase, the equation might still make sense. So the government has put a range of measures through, for example, with removing the interest deductibility for property investors, things such as bright line tests extending out to 10 years, and then also with the high LVR requirements and deposit requirements. So all these things do make a difference, but at the end of the day, it does come down to what is that in terms of this equation of cost of borrowing versus rate of return, whether investors believe that there is still something in there for housing to be an attractive investment.
And then when you overlay things like supply chain shortages, and Mark and I on this webinar, probably people, I'm sure we've mentioned it a number of times, sort of the price increases, say that placemakers put through were huge double-digit increases across a number of different construction products. When you think about the cost of construction, and look, I might be London-based, but I'm still reading the New Zealand news, and it's actually quite nice to read New Zealand news when you get to the UK, because it's just overwhelming what's going on here. But in New Zealand, there's reports around people who have put money down for an apartment or whatever, and then the cost has been blown out and they're kind of having to stump up more money. When you think about your forecasts and the cost of construction, is this a longer term play, or is this a short term phenomenon that you think sort of washes out over the next year or so?
So it is. I would say it's more of a short term phenomenon, of course, being acknowledging that for the people that are affected, it is a very significant part of the cost at the moment. But in terms of, working with a lot of quantity surveyors in the nature of my work, we've been discussing, of course, this outlook for the construction cost escalation and what it means. So at the moment, we've got construction cost escalation, particularly in the residential construction space, running at double-digit figures over the coming year, and how long this will persist for. And the thing with most markets is that generally, when you have very strong cost increases, you do tend to see a reaction, or both to the strong increases, you'll see a pullback in demand. So, for example, some projects are no longer feasible to go ahead. So you'll see that demand start to pare back in response to that high price increases. And then also at the same time, you also see a supply response as well, because pricing generally is a signal for more resources to be diverted to that producing that. So when it comes to these global supply chain disruptions, of course, it's a lot harder for that supply response to come through, because it is what's going on externally, which is largely beyond our control. But that said, for example, when it comes to wages, we've had stronger wage growth. This very acute labour shortage in the construction sector is pushing up wage growth in the sector, and so drawing more workers into the sector. And particularly as international borders start to reopen over the coming year, you would expect to see that businesses will start to find it easier to bring in workers from overseas to alleviate these acute labour shortages, and that in turn you'll start to see the increased supply of workers start to contribute to that moderation in construction cost escalation. So in short, yes, in the short term, construction cost escalation very high, but because you'll start to see some demand pushback and also supply response in some areas where it's possible, then it will start to moderate beyond that.
I guess what's interesting in that case is, do people start delaying things, and then that really what slows down the economy, because construction slows because people want to delay before as prices are expected to decrease. And then that's the sort of the multiplier effect, isn't it, when we're such a construction-based economy?
Yeah, so I would say that even as construction cost escalation is moderating, bearing in mind that it is still cost increases, but just that the rate is not going to be increasing at those double-digit levels annual growth that we're starting to see, and we're likely over the coming year, particularly in the residential construction space. But you're right, in terms of you do hear about pushback from property developers and thinking, well, if it's costing this much, some projects might no longer be feasible, and so it makes sense either just to put it on hold or just see how things pan out over the coming years. So it really comes down to that cost of borrowing, rate of return equation. And so when it starts to become too costly, some projects might just no longer be financially feasible, particularly against this environment of rising interest rates.
Fascinating, Christina. Look, it's probably a good segue into the work that you've done around predictions in the economy. Should we jump into that presentation and have a look at what you've done and what your thoughts are?
Yeah, sure thing. So I'll just bear with me while I share my screen. Right, can you all see that?
Yes, perfect.
Right, so this is the presentation that I did just over a week ago at our quarterly predictions, which the presentation I do for our members. Certainly the slides are still relevant, which can sometimes hard to tell in this fast changing environment. And so what I'm going to do is run through a lot of the charts to show what's been going on in the New Zealand economy and what it suggests for the outlook ahead, and then I'm happy to take questions, which I believe James will moderate. So along the way, feel free if you have questions as well or else I have a Q&A at the end. So in terms of what we're actually seeing, firstly, relative to the last lockdown, because of this prolonged nature of the lockdown in Auckland, where Auckland spent 107, looking to be less of a V shape than what we saw last year, the lockdown last year. Also, the fact that as the lockdown dragged on, however, I should also mention that more recent indicators suggest that actually the decline in activity hasn't been as great as initially feared, certainly at the start of when we first entered this the lockdown. So overall, what it means is that we're likely to see a more shallower but more prolonged decline in the New Zealand economy. So as I was explaining to my CE when we were talking about the outlook for economy, a little bit more like a Nike swoosh than a V-shaped in terms of that profile for quarterly GDP. Now, in terms of one of the aspects that is very apparent in this current situation is that supply constraints remain very acute, and that reflects as we were talking about, the very acute labour shortages, and then also with the global supply chain disruption. So overall, what that's meant is contributed to very strong inflation pressures in the economy. And what we're seeing is that the Reserve Bank is starting to respond to that by raising interest rates, but it will still be fairly cautious. We expect in terms of the Reserve Bank has indicated that it will continue to raise interest rates over the coming year. But we do expect that it will be quite cautious in its interest rate increases. We've penciled in a follow-up in February and then 2 more later next year. And that just reflects the fact to rein in inflation pressures, but noting that it is on the more cautious side of what others are predicting in terms of interest rate increases. And we do expect that as households start to roll off their fixed rate mortgages and their mortgage start to be repriced, then the impact of those higher interest rates will start to bite a bit more and have that more of an impact felt in the economy. So as I was saying, given the more prolonged lockdown in Auckland and some of the neighbouring regions, what we're expecting is a shallower decline, but more dragged out over the coming year. As you can see, a different profile from the V shape in terms of the short and sharp bounce back that we saw last year. So in terms of the current outbreak and what it's done for confidence, that's one of the key aspects where we've seen it reduce both consumer and also business confidence. Because we're dealing with such a high degree of uncertainty, it does make it hard for both businesses and households to plan ahead. That said, though, while households are feeling more cautious in regards to spending, one of the positive factors is that hiring demand still remains very strong. So with this employment confidence amongst households, that is still underpinning for now the robust retail spending that we've been seeing. of course, the longer this drags out for with more changes and then we're likely to see further declines in consumer confidence. But at the moment, the positive labour market outlook is we believe, will underpin a fairly resilient household sector. So as I was saying, labour shortages have become very acute, and that's particularly the case for skilled labour. We're seeing that across the board, but particularly so in the construction sector, and that reflects partly the border restrictions that still remain in place, which makes it harder for businesses to bring in workers from overseas to alleviate this business shortage.
When you talk to government about these sorts of things, Christina, do they give you insights in when they think that will be alleviated, or are they more listening to your research and not really inputting to help you forecast better?
I think there is an understanding amongst government of the key role that immigration policy plays in helping to alleviate labour shortages. Certainly prior to COVID, there was a lot of acknowledgement that, for example, in the agriculture sector, the labour shortages, we did work, for example, in Ashburton, and understanding that there needed to be some changes in immigration to allow, if we were to continue to have regions that are able to grow and thrive, that immigration would play a big part in that. So there is that acknowledgement. But then, of course, in COVID times, the public health aspect of it becomes a much more dominant factor when it comes to immigration policy. That said, though, it is something that the government is continually reassessing, and certainly in discussions with, say, Treasury in terms of when borders will be reopening. Let's face it, there is, even amongst them, a high degree of uncertainty over when they can reopen borders, and even as we can have seen with the new variant, changes to ahead. Firstly, the AUT Centre for Social Data Analytics uses the more timely data on benefit payments and filled jobs, and that shows the unemployment rate likely to be around 3.5% for the October month. So overall, it indicates that the labour market is going to remain very tight in the final quarter of this year. We forecast the unemployment rate will fall to a low of 3.2% over the coming year. And what that means is that generally, with the labour market still resilient, with wage growth likely to pick up because of these the very tight labour market, that will support household incomes. So as I was talking about the very strong construction demand, particularly so in when we look at residential construction demand, and that's one of the key positive factors driving the recovery in the New Zealand economy. The latest consent issuance data showed that for the year to October, new dwelling consent issuance totaled over 47,000, with particularly strong growth in parts of the North Island. Auckland also in particular had the highest number of new homes consents for the year at almost 20,000. And then also nationwide, when we look at the number of new dwellings consented per 1,000 residents, that edged up to 9.3 for the year to October. And that's quite a sharp increase from the 7.5 a year ago. So what we're likely to see is that as this housing shortage has put a dampener on house prices. But worth noting that this growth is concentrated in how residential construction demand is concentrated in medium density housing, so such as townhouses, flats. So when it comes to where this, what we're likely to see more of over the coming years in terms of this new housing supply. It's likely to be, we're going to see more medium density housing. When it comes to construction for infrastructure, the pipeline's also very strong, with the New Zealand Infrastructure Commission estimating that the pipeline of infrastructure projects increasing to 64 billion. And of course, as we were talking about, this very strong demand has led to capacity pressures building up in the construction sector. And we expect that this will to some weigh on the extent to which construction activity will ramp up over the coming year, even though underlying demand itself is strong. So when it comes to businesses, given the increased uncertainty, we're starting to see businesses a bit more cautious when it comes to investing in both buildings and plant and machinery. And as I was saying, it started to affect, for example, the pipeline of commercial construction activity. When it comes to investment intentions for plant and machinery, we're seeing what this meant is some unwinding in the rebound in demand that we've seen over the past year, as acute labour shortages had sharpened the focus for a lot of businesses on investment in labour-saving technology. So as wage growth picks up, businesses are starting to think about more cost-effective ways of doing things that involves the greater use of technology. But that said, given the high degree of uncertainty, there is more caution in terms of committing to some large-scale investment as well. This chart here shows how the services sector versus the manufacturing sector, how they're faring. And it shows a very different story, the uneven impact of the lockdown and the outbreaks. The fact that manufacturing activity has rebounded as restrictions were relaxed around the country, but services activity remained in contraction. So that reflects, firstly, the containment and social distancing measures on the services activity, but we also expect that as we move into the traffic light system, there will still be continued concerns about the spread of COVID-19, and that will likely weigh on services demand still over the coming year. So this time, in this edition of the quarterly prediction, so every quarter we do a special feature on a topical issue, and this time around we looked at what the latest Stats NZ business demography stats showed in terms of how the impact of last year's lockdown and border closures have affected businesses in New Zealand. And overall we find that while the number of enterprises has not changed significantly, the impact has been uneven across sectors and the regions. So both the birth and death rate of businesses picked up for the year to February 2021, so indicating a high turnover rate across the sectors. Admin and support and professional services and transport had the highest enterprise death rate. So that reflects the impact of border closures on the travel industry. Also the fact that with the closure of bank branches and post shops, that's contributed to the enterprise death rate in some of the regions. And when it comes to Maori enterprises, there was a decline over the past year of about 1%, but when it comes to employment in these Maori enterprises, that fell 18% over the past year, particularly in the Maori transport space. That employment in that subsector fell by 96%, and that reflects the average of around 2,500 employment in the Maori transport enterprises over the past 5 years, now falling to around 90. So that shows just how great of an impact it has on particular subsectors of the economy. In contrast, though, the number of Maori education and healthcare enterprises has increased significantly. So while the outbreaks has been generally negative for Maori businesses, some sectors have thrived. And it's worth noting that the lockdown, particularly being concentrated in Auckland and Northland, we're seeing the latest Centrix data showing increased levels of debt stress for businesses in these regions. So that's something worth to watch out for over the coming year in terms of just how resilient businesses are. And given the prolonged nature, it is likely that particularly in Auckland, we're likely to see a greater turnover of businesses over the coming year. When it comes to commodity prices, is we're seeing a strong rebound, strong growth in meat and dairy, particularly from China, although there are concerns about slowing growth in China as the economy continues to grapple with the COVID-19 outbreaks, and also the financial stability in the Chinese economy, given the indebtedness of some major property development funds. In absolute terms, though, it remains a very important export market for New Zealand. And then also, of course, with the recent global dairy trade auction showing continued increase in global dairy prices, Fonterra more recently has revised up its dairy payout for the current season to a midpoint of $8.70. So that's actually above the previous peak of $8.40 that we saw in the 2013-14 season. So certainly it's from a on-farm gate returns, it's a very positive story. However, worth noting that on the flip side, costs have also risen quite sharply for farmers, with the farm expenses price index showing a particularly large increase in the cost of fertilizer in the September quarter, and also with higher freight and packaging costs that all contributed to a 4.7% increase in on-farm expenses over the past year. Despite all this uncertainty, though, we are seeing a recovery in business lending to businesses. So overall, businesses are still looking to borrow, and more so, I should say. And then also when it comes to household credit growth, that's slowing, but from very high levels. When it comes to both the supply and demand for borrowing, firstly, looking at the demand story, we're seeing that there's been stronger demand for borrowing in the agriculture sector and for residential and commercial property. But when we look on the supply side, which is what this chart shows, we can see that the improved outlook, firstly, has in farm gate returns is supporting banks' improved appetite to lend to the agriculture sector. And also banks are feeling more positive about lending to the corporate sector. However, there's been more caution creeping in when it comes to lending for property. So that reflects the difference in the outlook that the bank sees in terms of where are the sectors that would be favourable to lend to. As we talked about, with the capacity pressures building up in the New Zealand economy, what we're seeing is strong surge in inflation pressures in the economy. So annual CPI inflation picked up to 4.9% for the year to September. So that's well above the Reserve Bank's 1% to 3% inflation target band, driven by higher food, fuel and housing costs. And also what we're seeing is that with the rise in household living costs, that's actually, unlike previous years, been quite high across the income deciles. So that indicates that the price increases have actually been quite broad-based. Also, we're seeing this rise in inflation pressures reflected in the lift in core inflation. That's with measures ranging from 2.7 to 4.8% for the year. And then of more concern is the increase in inflation expectations, which is what this chart here shows, particularly with the 2-year ahead inflation expectations rising from 2.3 to 3% in the September quarter. Wage expectations also picked up from 3.3 to 3.7% in terms of expectations for annual growth in hourly wages. What the Reserve Bank will be mindful of is the risk that the strong inflation that we're experiencing currently will lead to a wage price spiral should inflation expectations become unanchored. And that's why there's a lot more focus in terms of how to rein in this inflation before inflation expectations start to rise too high and become unanchored. So as a result of that, interest rates, with the Reserve Bank indicating that it would look to start increasing interest rates, we've seen this come through in mortgage rates, particularly in the fixed mortgage rates around the 1 to 2 year fixed terms. And noting that the rise in the floating mortgage rates has been more muted because that largely reflects the OCR increases, which only started from October. But certainly the expectation is that interest rates will continue to increase over the coming years in order for the Reserve Bank to continue to rein in inflation in the New Zealand economy. With most households borrowers on fixed rate mortgages, though, the effects of recent interest rate increases on households will not become apparent until well into next year when fixed mortgage rates come up for repricing. So around 60% of mortgages will come up for repricing within the coming year and 16% in the next 1 to 2 years. As households face higher mortgage repayments, they will likely start to rein in their spending. Certainly from the latest retail sales figures, it does suggest that for now, households are still fairly confident and spending remains robust. We do expect that as more mortgages start to be repriced at the higher mortgage rates, then you will start to see more of that the impact on households as they rein in their spending and readjust their spending accordingly. What this all means is that we expect that while the Reserve Bank will continue to increase interest rates over the coming year, it will be fairly cautious in the pace of tightening for the coming year. We've penciled in a follow-up OCR increase in the February meeting and 2 more next year for the OCR to be 1.5% by the end of 2022. It is a tough balancing act for the Reserve Bank in between reining very strong inflation against the backdrop of the uncertainty that the COVID-19 outbreak presents. Beyond 2022, we do expect further OCR increases as the Reserve Bank normalises monetary policy from very loose settings. So overall, what we're seeing is that with the widening spread of COVID-19 and prolonged lockdown, we do expect that will be a drag on the recovery to the degree that it will be much less of the V shape that we saw in the last lockdown of last year. Overall, though, we still expect that demand will be resilient, particularly with the household sector and employment still looking fairly solid. That will support household sector. Higher mortgage rates will start to have more of an impact next year as more fixed rate mortgages are come up for repricing. So for the Reserve Bank, it is about how to balance this ongoing uncertainty of the pandemic versus having to rein in inflation pressures, particularly with the quite market rise in inflation expectations, longer term inflation expectations that we've seen more recently. The risk is that if the Reserve Bank does too little, then there is a risk of inflation expectations becoming unanchored and leading to a wage price spiral. So overall, we do expect that the Reserve Bank will proceed on further tightening with caution.
Christina, it's a really, really interesting point. Oh, perfect as well, Q&A, so I'll just launch straight into it. Just on the Reserve Bank, if you think about your forecast for 3 hikes in 2022, that compares to a market that's assuming what's priced in at 6.6, so let's say 6 to 7 times, 6 to 7 increases next year. What's the key difference in terms of the caution that perhaps NZIR have compared to other players in the market?
So as much as, firstly, I would say money markets being more short-term focused, there is that focus on just how high inflation pressures are right here, right now. And certainly that plays a large part in, okay, inflation is high, we need to do something about it, this is what it'll take. That said, though, there is a lag between when policy measures are put in place and the time to which it starts to take effect. And at the moment, with a lot of borrowers, borrowers still on fixed rate mortgages that are yet to come up for repricing, the impact of high interest rates, we believe, has yet to hit home. And we do feel that that will be the case over the coming year as more, for example, I was just talking with one of my friends about it last week, and the fact that we've been fixed on, say, 2.2%. She was talking about how she's fixed on 2.2% for 1 year, and it'll be coming up for repricing in July next year, and that's when fixed rate mortgages are likely to jump to 4 point something. So you're seeing this doubling of mortgage rates, which we believe households have yet to take stock of and realise just the significance of that. So as more of that comes, this impact comes through, then we will start to see more of a slowing on the economy. Also with the new variants, then that does create a much larger degree of uncertainty over when things can get back to this normal that we keep talking about. And that comes down to from capacity pressures and border reopenings and how much that can help when borders can reopen to help alleviate capacity pressures. And so with this weighing on growth as well, all these factors being a drag on growth, we believe that the Reserve Bank, as we progress over the coming year and see the impact of these, the actions of the past year, then we will start to see more caution creep in when it comes to how much it chooses to tighten.
Christina, one sort of area you haven't really touched on is sort of government spending, and we've seen a lot of government spending over the last year. Does that sort of give you more confidence, I suppose, that, looking forward, we will probably continue to see that degree of spending, or maybe not to the same degree, but see spending, and that'll sort of cushion any sort of, I suppose, other slowdowns in the economy?
Really good point, and especially since there's a lot of focus, of course, at government spending, whether it's good quality spending, where they're spending it on. And what we've seen over the past year is that, for example, if we rewind back to the beginning of the lockdown last year, and there was all this talk that the economy was going to tank, we're going to have unemployment rate reach double-digit figures, and then what the government came in and was launched an unprecedented amount of government spending in order to prevent such a thing from happening. So what that shows is that the government will, if that's what it takes, pull out all stops to stop the economy from tanking, because it does have the ability to, through quantitative easing, getting Reserve Bank to provide that liquidity to help it to spend. So the government will be responsive if the economy was to slow quite sharply. So that does give some degree of confidence in the sense that, yes, there will be continued slowing in the economy, but we're unlikely to see it to fall to any significant degree because the government is responsive and willing to be out there and spending. And there are also, we can see that also come through in the continued increase in infrastructure projects that are coming on board, that there are also a lot of ready projects that the government is willing to go and invest in over the coming years. So that's one area where it would be reasonably, that would be an obvious way for the government to choose to support the economy through infrastructure spending. And then, of course, if anything, it's more we're seeing the capacity constraints in the construction sector, which is limiting the degree to which activity itself can ramp up. But certainly from a demand point of view, the government is very ready to step in.
Christina, we've just had one more question come through, conscious of time, but and it's sort of related to what Mark was talking about, but on the tax part of the equation. And going back to what we were talking about at the start of the session around house prices and things, how do you see things like capital gains tax taking effect? Is that something that you think about and talk about with government?
So that is something we do think about in terms of, it is a tough spot for the government to be in, particularly with opposition that is likely to be quite vocal about a capital gains tax that will be extended or be more widespread. So there is that balance between wanting to be seen to be doing something about addressing the housing market and reining in house prices, and where capital gains tax, and also not even from a tax take point of view, but from a what do we want the tax system to be, what that means. And so
maybe Zoom didn't like the discussion on tax. We'll just wait to see if Christina comes back. Otherwise, we'll look to move on. Look, just conscious of time, so we'll move on to the next part of the session this morning. And Mark, bond portfolios have been incredibly volatile recently. Not just the NZ Funds portfolio, bond portfolios. I should note it's been across the board. Perhaps we could, go back to basics as a second and look at some of the opportunities as well as some of the reasons why the volatility has been around.
Yeah, exactly. And I think, we have had feedback from a number of advisors and clients just to, I suppose, looking to sort of more fully understand the mechanics behind the sort of ups and downs and prices that we've seen in bonds of late and what's driving the mechanics behind that. So, the piece that I've written is very much, I suppose, there to be used as a reference piece for advisors to use with clients, or if clients sort of want to dig a bit deeper. But I'd say there's sort of, three things which I think people need to look at. And for a bond, if you take it back to its simple the starting point, as an asset, its return is comprised of two components, as with really any other asset. Firstly, that's the income that it will generate, and then secondly, what is the capital value of that asset which you hold. Income, first of these is pretty simple to determine for a bond. Obviously, typically you get a fixed income through the coupon that it pays quarterly, semi-annually, or maybe even annually in some cases. And from that point, that's a very simple and easy to understand. It's the capital value aspect that may be a little more, or creates a little more confusion. And that's the value can move in a way which is probably not immediately obvious when you before you sort of delve into it. And I think the example I tend to use is coming back to property. People here know property pretty well, so it's a good way to sort of think about how that valuation can change. And if you think about over a short period of time, a property, well, over all periods of time, a property generates income through rent that either the rent that your tenants pay or the implicit rent that you would sort of otherwise be paying if you own your own house. And in that sense, if you've got a tenant paying rent over very short periods of time, that rent won't change. There'll be sort of maybe a 1-year contract or something like that. So really that income's not very different to the bond income in that sense, that it is a fixed payment over a period of time. And given that, if you think about the way in which valuations come through, in Auckland, house price might be worth $1 million. And if you're getting, say, $30,000 a year of rent on that, which is fixed, that implies a yield of 3%. Now, what happens if, as we've seen over the last year, house prices do move up? Say the market value of that house moves up by 10% to $1.1 million. You've still got the same rent. You're still earning the $30,000 of fixed income. So what that does mean is that the yield on that, the interest rate essentially that you're getting on your $1.1 million has fallen because the value's gone up, the asset. So your yield has fallen from 3% to 2.72%. Conversely, if we went through a period where that property fell in value, say it fell from $1 million to $850,000, that would actually see your yield increase from 3% to a little over 3.5%. So really what this shows is that if you have a fixed income asset, you get an inverse relationship between where the yield goes and where the price is. So it means when yields rise, prices fall, and conversely, when yields fall, it means that prices are rising. And it's not an immediately obvious relationship, but when you think about that fixed income versus a changing price, that's what drives that. And that happens, it happens clearly in the property market, but it happens exactly the same. The same mechanics happen in a bond. So really, I suppose that question that you've then got to ask is, what changes that market yield or that market interest rate for the yield for a bond? And really I suppose there are three things to sort of think about. The first is, as we've talked a lot about, the general level of interest rates. We've had a strong view this year that interest rates need to move up. They have moved up, certainly in New Zealand. Internationally, they moved up at the start of the year and have moved sideways to lower to up, and then again lower over internationally. But as that level of interest rate, the wider level of interest rates in the economy change due to things like economic activity, optimism about the future or pessimism about the future, or actions of central banks. The Reserve Bank raising the OCR tends to push up interest rates. That really means that market yield at which the bond is compared against changes. So, in that situation, you may find, and I used an example of a Kiwi Bank bond in my article, that bond was issued in November last year when interest rates were much lower. So it had a coupon of 2.36%. Move forward to now, the market yield on that bond is about 1% higher at 3.35%. You haven't seen any change in the quality of Kiwi Bank. The fact that interest rates are higher or the interest rate on that bond is higher has no reflection on the underlying issuer. It's more a reflection of what the level of interest rates are in the wider economy. But because that yield is higher, that does mean that the price of that bond has fallen from essentially $100 to around about $96. So that has impacted even though Kiwi Bank itself hasn't had any impact. The other one is really coming back to those general issuer risks, so in the sense that, not now, but during the GFC, people were very concerned about the quality of banks and the ability of banks to meet their obligations going forward. So in that situation, people would demand a larger or a higher return, a higher level of interest rate to be willing to buy those assets. So in that situation, that equally, if there's an individual concern about a sector, a type of say, energy bonds or financial bonds, or concerns about an individual company, then that will impact. Again, it will change that level of interest rate that individual bond faces. And again, if that level of interest rates increase, that will push down the price. Equally, if we get to a situation where the world becomes very positive, or individually a company goes through an event which dramatically improves its credit profile, that will see that interest rate compress. And in that case, prices are going up. The last point I wanted to touch on is really term. And we've talked about this a few times, but, the term of a bond or its time to maturity does have an impact on its price and its price sensitivity. Bonds here typically are issued for periods of, say, the shortest probably about 3 years, but typically sort of 5 to 7 years and occasionally a bit longer. The longer your investment term, it means that any changes that happen in the level of interest rates become compounded. So they sort of don't really, in that sense, they don't impact over 1 year, they might impact over 3 years, 5 years, or 10 years. So that sort of becomes a cumulative impact. And, the rule of thumb very much there is you multiply your change in your interest rate by your maturity. So the example I used in the paper, if interest rates move up by 1%, much as they've done for that Kiwi Bank bond. If they move up by 1%, you multiply that change by the maturity. So if it was only 1 year, it would be -1 times 1 year. That would give you a -1% change in price. However, if you had a 10-year bond, that would be -1% times 10, which gives you a -10% change in price. So obviously the term is very important. And if we think about some of the volatility that we've seen in our portfolio and also in the wider sort of bond portfolios across New Zealand, that term is one of the key reasons we've seen that degree of volatility. Because most bond funds typically have an average maturity of around about 5 years. So if interest rates have increased, which they have in New Zealand, not so much offshore, that inverse relationship between yield and price has meant you've seen some price declines. Now, we've talked a lot here about our ability to manage interest rate changes. And, in NZ funds, we do look to actively manage those interest rate changes. As active managers, we don't always get it right. Or even if we are right, we may have our timing wrong and be too early. So, that is the nature of active management. So that is that for periods of time, our returns may not be as good as what can be achieved elsewhere in the market. But I think, the good news that we take from that is that really, we firmly believe that active management is the best way for our clients to sort of achieve their long-term goals, and it's the best way for us to invest clients' money for the next 2 years, 5 years, or 10 years. Looking forward, we continue to see plenty of opportunity out there. It is a challenging environment, but there's plenty of opportunity, and we do work hard every day to try and navigate that, ultimately to drive returns for the portfolios. And we do believe that going forward, that doing that in an active way will be the best outcome. So with that, James, I'll leave it, unless you've got questions.
I think the last thing I'd say about that, Mark, on the income portfolios is we've seen volatility in income portfolios, both at NZ funds and sort of in the broader market, on quite actually small changes in interest rates. Now, if we think they actually go back to levels where they should be to reflect an inflation rate that's 6% in the US, that's a huge change in interest rates and will have profound effects on portfolios that can't manage that interest rate. Because at the moment, we've only been talking 50 to 60 basis points of changes within 10-year rates at the moment, but really they should be 2, 3, 4% higher than they are now. And imagine the effect on a long-term bond if you do have interest rates increase that much. Now, I'm not suggesting they do that in the next 6 months or anything like that, but that's the environment that we see across the income portfolios over the next few years, and without being able to manage that becomes a tricky scenario.
Exactly. We've had an environment for 20 years where interest rates have gone lower, and whilst they may not go back to 4 or 5% immediately, there is a lot of changes in the global economy that put us on a path in that direction, at least.
And the final thing I would say then is, what do you do when you've got clients that want to be tranching into a portfolio or saving over time a lump sum, and really the difficulty is, what do you do? Because if you put it in cash with an inflation rate of 6%, you're effectively having a negative 6% return on the money that you've got in cash. But it does provide that, capital stability, and so really the option is to keep investing and keep tranching into those income portfolios, knowing over a longer term period of time they will overall compound and increase in value. That includes an inflation part of that, and the fact that we can manage interest rates. But at the same time, in the very short term, there is a cash fund there within the APS portfolios that can be used for tranching if need be. And so that would be the thing that we would look at when we're thinking about tranching and across the portfolios when you have a lump sum. Look, I'm conscious of time. It was a pretty data-orientated presentation today, but I hope also that summary that Mark gave around the bond portfolios gives a greater insight into where the volatility is coming from. If you do have any more questions on anything that Christina talked us through or that Mark discussed today, then do let us know. Otherwise, look forward to speaking again, same time, same place next week for our final session of the year until Christmas. So thanks very much and have a great week, everyone. And thanks, Mark, for your comments today.
Thanks. If I don't talk